All right, let's get right into it. 2025 was a bizarre year. We had what everyone called the everything rally. Stocks, real estate, gold, silver, you name it, it was flying. But the one asset that was supposed to be the star of the show, well, it was completely left behind. Today, we're going to unpack that mystery, the great crypto divergence of 2025, and then look forward to what's shaping up to be a make or break 2026. So, here's our roadmap. First, we'll dive into what actually happened in 2025 and figure out exactly why Bitcoin sat on the sidelines. Then, we're going to look at 2026, which is a real crossroads for the market. We'll break down something called the triangle theory. It's the secret sauce for what might be the next financial revolution. From there, we'll see who the new leaders in crypto might be, and finally, wrap it all up with a clear strategy for how to think about this brand new cycle. Okay, so let's set the scene for 2025. You had this massive wave of liquidity hitting the market. Central banks were basically telling everyone that lower interest rates were on the way. And what did investors do? They bought everything. Stocks, houses, precious metals. It was a textbook everything rally. But, in this sea of green, there was one huge asset that was just treading water. And when you look at the numbers, the difference is just staggering. I mean, look at this. Silver had an absolutely incredible year, up 168%. Wild. Gold, the classic safe haven, surged 70%. And then you've got Bitcoin, the asset everyone calls digital gold, which actually finished the year down 6%. I mean, what is going on here? So that really brings us to the core question, doesn't it? In an environment that should have been picture perfect for Bitcoin, why did it stumble? Why did all that money, looking for a safe place to land, go for shiny physical rocks instead of its digital heir apparent? Let's dig in. Well, it turns out it wasn't just one thing that held Bitcoin back. It was this perfect storm of two major forces. One was external, all tied up in politics and promises. And the other was internal, coming from the very people who believed in Bitcoin the most. First up was the so-called Trump trade. You see, the market got way ahead of itself. Everyone was expecting this super pro-crypto administration to come in and start a strategic Bitcoin reserve, buying up tons of Bitcoin on the open market. But that's not what happened. The reality was, kind of boring. The reserve was just a paper shuffle, relabeling Bitcoin they had already seized years ago. No new money came in. In fact, the administration's real priority turned out to be US dollar stablecoins. So yeah, the big government buyer everyone was waiting for, total no-show. But honestly, the bigger story was happening inside the network itself. While all the new investors were excited, the original Bitcoin pioneers, we're talking the OG whales from back in 2013 to 2017, they saw the rally as their one perfect chance to finally take profits. And boy, did they. On-chain data shows their selling more than doubled, from 12,000 Bitcoin a day to a staggering 26,000 every single day. The problem was, all that new ETF money had already been invested earlier. There just wasn't enough new demand to soak up this historic tidal wave of selling from the early guys. So after that really strange performance in 2025, the market is now totally split on what's coming next. It really feels like we're at a crossroads, with two completely opposite theories battling it out. One that's pretty bearish and another that is incredibly bullish. So here are the two camps. On one side, you have the bears. They're saying, look, history doesn't repeat, but it rhymes. They believe the old 4-year cycle is still alive and well, that the 2025 high was the top, and we're heading for a classic, painful 70 to 80% crash. But on the other side, you've got bulls like macro analyst Raoul Pal, who say the old cycle is broken. They believe we're in a much longer 5.4-year liquidity cycle, and that what we just saw was just a breather, a mid-cycle correction before the real show begins. Now, this bullish theory really hinges on this wild concept called the banana zone. It's the name for that final, crazy, euphoric part of a bull market, where the price chart just goes almost vertical. The theory is that this phase has just been delayed, but it's still coming. And the trigger, well, it's predicted to be massive liquidity injections from the government leading up to the 2026 U.S. midterm elections, all designed to make the economy look great and win over voters. And that brings us to the real core idea of this whole analysis. Because no matter which cycle theory you believe, there's a bigger shift happening underneath. The how of the next rally might matter a whole lot more than the when. The market is changing in a fundamental way, and it's being driven by something called the triangle theory. This new cycle, this whole new chapter, is supposedly going to be built on one single transformative idea: real-world asset tokenization, or RWA. Now, it sounds super technical, but the concept is actually pretty simple. It's just about taking real-world stuff, things like buildings, private company stock, even a piece of art, and turning it into a digital token on a blockchain. The goal is to unlock the trillions and trillions of dollars in value that are currently locked up in these hard-to-trade assets. But for this RWA revolution to actually happen, you need three key things to all click into place at the same time: institution, market, and technology. And the argument is that 2026 is the year this triangle finally gets completed. On the institution side, we're finally getting some regulatory clarity with rules like the Genius Bill for stablecoins. On the market side, there's just huge pent-up demand to make illiquid assets easy to buy and sell. And for technology, a clear winner has emerged as the standard platform to build all this on. Let me give you a really simple example to make this concrete. Think about airline miles. Right now, your miles are trapped. They're just points in your account, and the airline controls everything you can do with them. But what if you could tokenize them? Suddenly, they become a liquid asset. You could sell your miles to someone who needs a last-minute flight, and they could buy them at a discount. You instantly unlock the value of something that was just sitting there. Now, imagine applying that same idea to trillions of dollars in real estate. Okay, so if the whole game is changing, if the next cycle is really all about real-world utility and tokenizing everything, well, that has a massive implication. It means the leadership within crypto itself is about to get a major shakeup. The winners of the last cycle might not be the winners of this new one. And the key thing to understand here is the basic difference between something like Bitcoin and something like Ethereum. Think of it this way. Bitcoin is digital gold. It's a vault. Its job is to store value, and it does that brilliantly. But it's not designed to do a lot of complex stuff. Ethereum, on the other hand, is more like a digital factory. It's a utility platform. It's the programmable foundation where you can actually build and trade all these new tokenized assets. It's why huge firms like BlackRock are already building funds on it. One stores value, the other programs value. So what does this all mean? It means the focus of the really big institutional money is shifting. They're moving beyond just passively buying Bitcoin and holding it like gold. Now, they're looking to actively use Ethereum's infrastructure to build the next generation of finance. The big money isn't just buying crypto anymore, it's building on it. Now, this kind of fundamental shift also creates a huge risk for some of the older crypto assets, the ones with outdated stories. A great example is XRP. Its original purpose was to help banks move money around faster, replacing the old SWIFT system. But here's the problem. Banks aren't leading financial innovation anymore. Big tech companies like Apple and PayPal are. And these new players don't want to use a volatile crypto asset to move money. They want to use stable dollar-pegged coins. The rise of regulated stablecoins basically makes XRP's main reason for existing kind of obsolete. Okay, let's bring this all home. We've got these two competing cycle theories, this huge fundamental shift towards real-world assets and a potential change in leadership. So how on earth do you navigate all of this? Let's put together a clear strategic framework. It really boils down to what you could call a minimum regret strategy. First, prepare for both possibilities. You have to acknowledge the very real risk that the 4-year cycle plays out and things go down more. But you also have to stay in the game in case that liquidity rally kicks off in late 2026. Second, recognize that leadership is changing. That might mean thinking about shifting focus from purist stores of value towards the utility platforms that are going to power this RWA revolution. And third, just apply a critical lens. Be really skeptical of assets whose entire story is based on an old version of the financial system. So the ultimate takeaway, the big idea here, is that we are right on the edge of a massive transition. The era that was driven purely by hype and speculation, what some are calling the fake cycle, that might be ending. And it could be giving way to a new era driven by actual, tangible, real-world use. This is the real cycle, and it completely changes what gives these digital assets their value. The wave is coming. And all of this leaves us with one last big question to think about. As this new financial system gets built block by block, on-chain, the people building it, the architects, and the biggest winners, they might not be the names we all expect. The game is changing right before our eyes. Thanks for tuning in.